thank you to everyone for joining us today. My name is Marcia Zappa, and I am the Director of Marketing and Business Development at Affiance Financial. I'll be moderating today's conference call. I want to start out by clarifying that this is a call, not a presentation. There are no visuals, so if you are joining by phone, you aren't missing anything. Due to the number of people on this call, all participants have been muted. If you have questions and are joining by computer, please use Zoom's Q&A function. I will be monitoring it during the discussion and will do my best to facilitate live answers to your questions. If we are unable to answer your questions during the call, we will follow up to the best of our ability. But please don't hesitate to reach out to your advisor as well. Today we have Principal and Financial Planner Andy Fishman, Principal and Financial Planner Steve Lear, and Principal and Chief Investment Officer Seth Meisler. Andy, would you please start us off?
I will, Marcia. Thank you. I want to make sure, again, pass on our that everyone is healthy and staying at home and I guess quarantining themselves. I want to welcome everyone. This is our fourth conference call. We hope that they're beneficial to everyone. I want to just take a minute here and lean on history a little bit. I know history is no guarantee of the future, but in markets, it tends to repeat itself frequently. So since 1950, economic expansions have lasted on average 60 months. Economic recessions have lasted 13 months on average. Thus, you can see that expansions are larger and longer than the downs. Thus, the market tends to go up over time. Looking at the 15 worst stock market days since 1950, the average return 1 year later is about 24%. And if you look out for average returns after a bear market, after 3 years, after it's found the bottom, the average return is 14.1%. So I just wanted to relay a couple of these data points, and we'll get into more information on kind of the CARE Act and Seth's narrative. The final piece here is diversified portfolios do not generally win in the short term. Because when markets are up, being invested in a diversified portfolio makes you feel like you're losing a little bit. And when markets go down, you still have negative returns. But when you look at diversified portfolios over time, 10, 15, and 20 years, they win and they outperform. So please keep that in mind. Moving on to the bigger news this week is the passing of the $2 trillion stimulus package, the Coronavirus Aid, Relief, and Economic Security Act, also called CARES, was officially enacted this past Friday on March 27th. The bill is so new and so comprehensive that our entire industry is still sorting out the details and figuring out how best to implement all the changes. So Seth will be sharing some of the information that we know right now about CARES Act today, and we hope to continue to gather more information in the coming weeks. So Seth, maybe take it away and give us some of the critical pieces that we know today.
Yeah, thank you very much, Andy. So before we begin, I'll start with an important disclosure. Please remember that with investing, there can be no assurance that the content made reference to directly or indirectly in this conference call will be profitable or suitable for your individual situation or prove successful. Due to various factors, including changing conditions, the content is only reflective of current opinions or positions and is subject to change at any time and without notice. Moreover, you should not assume that this call serves as a substitute for personalized investment advice from Affiance Financial. Please remember to contact Affiance Financial if there are any changes in your personal financial situation or investment objectives. So much has happened since last week. As Andy mentioned, on Friday, Congress passed the CARES Act. At only 895 pages, it's a little bit of an assortment of everything. And by next week, we hope to have a more complete summary of the CARES Act, but we wanted to give you a few important highlights. Number one, the laws allowing for student loan deferral. No federal payments are required for student loans until September 30th, 2020. For those whose student loans are in auto draft, you will need to stop the payments, either through your bank or reaching out to your loan provider.
Seth,
And for those,
I am so sorry. We are unable to hear you. You are still cutting in and out. Thank you again for preparing all of this information for us. That's super helpful, but I am going to ask Mark Usum, co-chair of the investment committee, to step in at this point and share the thoughts that Seth has prepared, just so we can make sure that everyone can hear them loud and clear. Mark?
Yeah, thanks, Marcia. Sorry about that, everyone. I'm sure we'll get some better audio in place, but hopefully this is clear, and I'll step in. Seth was saying student loans can be deferred. No federal payments are required until September 30th of 2020. And if you're on auto draft, you need to stop the payments either through your bank or reaching out to your loan provider. And for those in public service and are trying to get those loans forgiven, the 6 months count even though you're not making a payment. Second point is healthcare help. Over-the-counter medications are now being counted as a medical expense. Those people in high deductible health plans will be allowed to receive COVID-19 vaccines at no cost when, and hopefully, when that's available. Medicare Part D recipients can receive 90-day supply of medications versus the normal 30, so you don't have to go back as often. Third point is gig workers, people that don't have an employer per se, work for themselves, are able to receive unemployment benefits. That is a new part of the act. Fourth point is required minimum distributions will not be required in 2020 at all. So if you were taking out money, you don't have to if you don't want to. In addition, Congress has eliminated the 10% penalty for early distributions from an IRA for coronavirus-related distributions, meaning if you had to take out money due to coronavirus reasons. You also have the option to spread the tax on that. While there's no penalty, there's still tax if you took out money from your IRA. You could spread that tax over 3 years, and you'd have the ability to recontribute those same amounts back. You could put it back in the future. And employees can now borrow up to $100,000 from their 401k plans, where before it was only $50,000. So some more flexibility around withdrawals and loans from retirement plans. Fifth point of 6 here, there are a number of small business perks that are part of this plan. There's a lot of detail we'll get into over the next week or so, but small businesses have the ability to take out loans to stay solvent. And finally, there's cash. This is the helicopter money they talk about. Cash being sent to families. So individuals who have less than $75,000 in income will receive $1,200, and married couples with adjusted gross incomes of up to $150,000 will receive a check from the government for $2,400 plus $500 for each child, and I think that's under 17. The direct payments do phase out when income gets above those $75,000 for individuals or $150,000 for married couples. So that's sort of the highlights on the CARES Act. Again, we are going to dig much more deeply into this over the next week or so and have more information, but please stay tuned. But these were some of the highlights. Last week, we received unemployment numbers, shifting a little bit to the economy, which were pretty much in line with expectations and really bad. About 3.3 million filed unemployment claims. Since then, a number of companies have announced furloughs, Macy's being one of the most notable, or those are temporary layoffs. So not a big surprise, but clearly a big number. There was also an article we thought was notable by John Reckenthaler from Morningstar that summed things up nicely, talking about stages of bear markets. So the first stage, roughly starting out being recognition that there's a problem. The second stage being panic. And I believe we're in the third stage, which is stabilization and is characterized by turbulence. Stocks have recovered a bit, but we are by no means out of the woods. As expected, both the inflection rate and death toll from the virus probably will sharply increase. And today is the end of the first quarter. So we'll soon start to receive some economic data as well as corporate profitability numbers as companies start to report earnings in April, which will give us a better sense of the economic impact of the shutdown. Keep in mind, first quarter will be a mix of normal and definitely abnormal economic activity and earnings. We're anticipating the market may not react well when the data comes out. So this period probably will be marked by a significant amount of volatility, a number of false starts. And this is where it's said that markets can break your heart and your conviction. We continue to believe we likely have another 2 to 3 months of an economic slowdown ahead of us. And while the economy may be slower, that doesn't necessarily mean the stock market will recover at the same pace as the economy. Generally, stocks tend to react before economic news, meaning stocks will probably go up before the economy gets better. On a positive note to end with, there's a fourth and final stage to the bear market, and that is anticipation when stocks begin to recover. As with most bear markets, almost no one will realize the recovery is happening until it's already here. In fact, this period of time is usually accompanied by articles stating it's the end of stock investing, so we'll look for those. This is generally the point where many investors have already bailed out and commit what we call the second of two mistakes. The first mistake is getting out too late, and the second mistake is getting back in too late. Both mistakes are premised on our inability to time the markets, and we recognize both the dangers and opportunities when they arise. So it's for this reason that we are continuing to stress thinking long term. Even though markets are swinging wildly, it is very, very difficult to predict and time the markets. So these are current projections and certainly subject to change. And the point is that we don't believe we can time the market. Our suggestion is continue to think long term and that we will get through this. There will be an end, and we have built diversified portfolios focused on your long-term objectives. Those are our comments from economics and stock side. Steve?
To Andy and Seth and Mark, thank you so much for one, the historical perspective, two, the update on the new tax laws, and three, and some of the economic situations that we're thinking and the investment issues as we go forward. As all can tell, our crystal balls are very, very cloudy with lots of cracks in them. One of our favorite sayings at Affiance is that we help people prepare for the certainty of uncertainty, and we are clearly living in uncertain times. And I was talking to a client earlier today and say, you know, it's always been uncertain. We're always dealing with this uncertainty, and this is what we truly pride ourselves in, is being able to deal with this certainty of uncertainty. So what we're trying to do so hard is put each client, because each of you has different needs, different concerns, and get each of you into a situation where your investments and your finances are matching what you're trying to do. So I definitely urge you, we are here. I've talked to everybody this week. We all talk to each other. The team is solid. The team is here to serve. The team is ready to answer your questions. Please do not hesitate to reach out to us about your particular situation, and so that we can map out the strategies to meet your particular situation. Marcia, I think it's time for questions.
Okay, thank you, Steve. We do have one question so far, so please, all of you out there listening, don't hesitate to get on the Q&A and give us some questions here. But Mark, we had a very similar question to this last week. I think Seth addressed it. Maybe this week you can give us your thoughts on it. What is the possibility of the economy going into a depression like the Great Depression?
Yeah, I think everybody's concerned about the economy and how it's gonna play out. And our sense is that we are not in a Great Depression situation. We do think that we could see a recession. We could see a period of weakness for sure. But we are going to be on a time frame that has some definition to it. We've seen things work out across the world in different places. Now, China in particular, where they actually don't have new cases, and it's been maybe 3 or 4 months. So I don't think we're into a multi-year long kind of depression like we saw in the 1920s and 30s. But we certainly could have a rough period in a shorter period of time here.
Okay, thanks, Mark. One more here. This one is specific to the CARES Act, so it may require a little further research. But Mark, do you know if the $1,200 or $2,400 payments, or whatever each
Yeah,
family is entitled to, if those are subject to federal or state taxes at the end of the year?
excellent question. I don't know the answer.
Okay.
We can
Okay.
look at it.
So whoever asked that one, that, I will make a note, and we can hopefully have some more information on that next week. Here's another question for Mark, or possibly for Andy. Mark, maybe if you want to address it first. Have you identified any specific companies or industries that are clearly going to benefit from the coronavirus and the dynamics of behavior that are changing because of it?
Well, the short answer is yes. There are certain industries that are going to benefit. We take a very diversified approach, and so from an investment perspective, we don't really buy specific companies or really specific industries. We do build diversified portfolios of mutual funds that hold a broad array of companies. But clearly there are some areas that are benefiting in the software area, in data centers, in delivery, in food service. So there are some places where this has helped some companies. But I think from our side, from our perspective, we are not going to be trying to sort of cherry pick. There's risk, of course, that in the short run, some of these are going to have terrific numbers as people start working off remotely, and some of those kinds of businesses benefit. But that can change and change rapidly. So we're not really trying to game or time again short-term swings. But there clearly are some opportunities.
Okay, Mark, we have some interest here in knowing your global economic outlook. Specifically, do you have any thoughts on the EU and the UK? And then a second question is, do you have any thoughts on the economic outlook for Mexico, a big trading partner? Have you started thinking about either any of those kind of global outlooks?
Well, we do. I mean, again, our philosophy doesn't change dramatically based on changes globally. We think the world is fairly closely correlated. We're going to have some rolling changes, with obviously China getting through some of this earlier in Asia as it's rolled through the global economy. We do think we'll see weakness, though, across the board, across economies, including Europe. UK is part of the mix. We know they're in the same or similar situation that we are. And as I think all governments and economies are trying to attack this at the same time in somewhat similar manner, we will move through the peak of the infection process. It will plateau and taper out over a period of time. And so again, I don't think we're dramatically different across the world in a timing perspective. We're several months apart, maybe at the most. Mexico, we know, has been slower in terms of the infection rates there, but our understanding is that it is increasing there as well, and will have some impact. in Mexico as well, I think similar to here. And again, I think we're, it's not like we're years apart, we're months apart, most likely, in terms of the effects. So it's bad news, good news in a way. Bad news in that we probably all kind of go through it in a similar time frame. And bad news is that we all kind of go through it in a similar time frame. The good news on the other side, though, is we probably start to recover in a similar time frame, and that hopefully sets the stage for a global recovery as well.
Okay. Seth, hopefully your microphone will be working enough to answer this one, because I know you're kind of our Social Security expert. And again, it may be too early to say, but will Social Security benefits be affected by either the coronavirus or the stimulus package related to it?
Thanks, Marcia. No, there should be no change whatsoever to Social Security payments.
Okay, so just in case you couldn't hear Seth, he said no, there shouldn't be any changes to Social Security. So Mark, the question is, did you say we will not be doing an RMD from our IRAs this year?
No, I said you have the option, meaning in 2020, you have the option to not take an RMD if you are taking them, or if you thought you were going to need to take one. You're not required to this year. You can, if that was your plan and that's part of your financial plan, you need that money, then it's totally fine. But if you didn't need it, you don't have to take it and or then pay the tax on that as well. So it is your option. Just another clarification, that also goes for beneficiary IRAs, inherited IRAs. And if you did take an RMD and you want to put it back, you can do that as well.
Okay, excellent. Well, that is all the questions all the big questions that I think we should address at this point. I really appreciate everyone's attendance today. If you are on a computer, when you exit the call, you will be directed to a quick 4-question survey. If you have time, we'd really appreciate hearing your feedback on it. It will be especially helpful in planning future calls. And any questions that were missed, hopefully we'll be able to get at the next week. So thank you very much, everyone. Enjoy the rest of your Tuesday.